Welcome to Coffee with Joe for January 21st, 2010. It's a Thursday. Joe, I want to try something here. It's a bit of a challenge. This is complex territory, this monetary system, monetary reform stuff. I want to try to make a 10-minute video that talks about the monetary reforms that we envision, how the system would work, and what the transition would look like out of a debt money system into a debt-free money system. You think we can do it?
Let's try.
Let's try it. Okay, let's go. Joe, first of all, the government would issue the money debt-free instead of borrowing it from the Federal Reserve. How would that work?
Budget. The government spends the money into existence. That's what the government does. The government credits bank accounts when it spends money, Pete. Okay?
It does that right now. It just borrows the money from the Fed first, right?
It does it right now, and banks do it right now. That's how banks create money, by crediting bank accounts. Okay? So, but they create the loan, all that other stuff. But in this case, it would be the banks would just be out of the picture of money creation, and the federal government would spend the money right into existence. Just like that, Pete.
So Joe, we got currency, and then we've got digital money. Basically, the currency, they just move the printing presses. Actually, the printing presses, ironically enough, are owned by the U.S. Treasury right now. The money's printed by the Treasury, and then the Fed actually buys that from the Treasury and then loans it back to us, gives it back to the Treasury in exchange for U.S. Treasuries for debt right now. So we're just cutting out that Federal Reserve piece in terms of the currency, and then the digital money would be created without borrowing it, right? Same way.
Exactly the same, Pete. Yes,
okay.
That's right. Exactly the same.
So the amount would be determined by the congressional budgeting process. Right now we have a congressional budgeting process, and it usually comes up with a deficit budget, right?
Right.
And
well, yeah.
How would you be sure that the amount of money created wasn't too much? Because everyone's first objection to this idea is it would be inflationary.
All monetary policy is aimed at monetary stability. Okay, that's the aim of it. And there's the theory behind setting federal funds interest rates to determine short-term or overnight borrowing rates, and then everything piled up on top of that. All of that is done with the goal of having sufficient money in the system to balance the needs of production and consumption without being either inflationary or deflationary. So that's the very quick, nickel sketch of how monetary policy is supposed to work. So we're going to replace all of that mechanism, Pete. But remember, there's an objective of having a certain amount of money to be created in any year, and again, that's part of the budgeting process. So we're going to have a process where the Treasury, basically under the Treasury Department, the Federal Monetary Authority, would be looking at all the things that are going on in the economy with regard to any measure that makes up the activities of the economy, to determine what that should be. And I'll say this about it, Pete. Whether you had fractional reserve banking or full reserve banking or government creating money or banks creating money, that amount, in order to be non-inflationary and non-deflationary, should be exactly the same. Okay? Whatever that amount is, it should be exactly the same. So in this case, instead of trusting to the weird manipulations of the capital markets, with the Fed trying to kind of push on a string, that's kind of the metaphor that that I see most valid here. No, it would be directly done by the monetary authority. And really the good thing about that, Pete, is this. Every year, the metrics, have to be reviewed. It's like any other kind of self-improvement process. Are you going to get it right the first year? Well, is there going to be any inflation created? Well, was there? Well, then why? Now, the question is, does it have to be perfect? And the answer is no. Obviously, it does not have to be perfect because, first of all, we've had incredible growth of the money supply over the last 10 years with not very much inflation. And the concept of having stability doesn't mean, zero, absolute zero inflation, plus minus negative zero. No, it just means what it means is that there's a rational amount of inflation and or deflation, year to year, so that over time it's stable. You really have to think of the monetary reforms, Pete, not about the transition phase, but about the long-term permanent phase of the money system being in place in order to have any idea about how it's going to work.
So, Joe, one of the benefits of the reforms would be that the money supply is no longer tied to people's willingness to borrow or banks' willingness to lend. But we don't have time to talk about the benefits of the monetary reform system if we're going to stay on it. Joe, right now, 100% of the money is created by the banks, I would say on three levels. There's the Federal Reserve level of money creation out of thin air, right? There's the fractional reserve level that's done by the banks. And there is the shadow banking side, all these derivatives and financial ephemera that we've had in the last few years. We would need to shut that down so that the government so nobody else is creating the money but the government, right?
Yeah, Pete. Let's go back to I'm sorry, but we've got to throw one big picture part of this thing here. We're operating on the principle of a proper principle of monetary sovereignty, Pete, okay? A national monetary system, a system that works for all the people. Now, the Constitution says only the Congress shall create money, regulate the value thereof, and a foreign coin. Is the Congress doing that today, Pete? They're not, but in the future they will be, okay? Now, if only the Congress can create money, and if the Congress is creating all the money that we need, why do the investment bankers, what's the excuse for allowing the investment bankers to create any additional money? We've got the amount of money in place that's non-inflationary and non-deflationary. Why is there a need for private bankers to do anything? So the answer is that we institute the government creation of money. There's adequate money in the system. We institute full reserve banking. I realize that's a controversial, issue sometimes. Once you have full reserve banking, then all forms of capital markets are going to be functioning with real money, Pete. Money that's already been created. Again, the transition phase, something that needs special considerations, because how do you go from fractional reserve to full reserve? That's a big deal. How do you remove the power of the shadow bankers to create any money? But if you think about it as an established system, we're 100 years with fractional reserve banking, Pete. Okay, creating money through banks issuing loans. It's kind of hard to break the mold and to find acceptance of it. So. Yeah, it's a reform. It's a major reform. It's the major reform that needs to take place, Pete.